Next 45 minutes, we'll talk, let's do this until 32 minutes, we'll talk about long-term assets. The major part of this chapter that you need to know about is depreciation, and we'll deal with that in a second. But first, let's talk about what makes an asset. What makes an asset is three things. Assets have to be tangible in nature, or what makes, a plant asset. Not just an asset, but a plant asset. A plant asset must be tangible in nature, it must be actively used in operation, and it has to have an expected future benefit. It has to be tangible in nature, it has to be actively used in operations, and there has to be expected future benefit. So let me go over two very famous court cases when it deals with this topic, and let me ask you, the scholar, what you think this is a asset or not. So we'll deal with the case of the toy maker. So there was a toy maker that had a toy store, and he had a toy business in New York, and the toy business was going well. However, the toy maker had a concern that society had become very litigious. Does everybody know what litigious means?
At one point I did.
No.
Oh, all right. So when I say litigious, I mean that very legally minded, or they're constantly suing each other, right, for little things. For example, when the lady spilled her hot coffee on herself from McDonald's and sued McDonald's for damages, right? So he was concerned about this. So what he decides to do, he says, I'm going to build a law library inside of my toy store. So that way, if I hire a lawyer, what I can do is get a discount on my law services by providing them free access to a law library, right? So he built this law library within his toy store and was putting it on his financials. Now I ask you, Scott, is the law library an asset of the toy company?
Yes.
Yeah.
Yes. Why?
You said that people were becoming litigious, so people are looking to use that space in that time period.
Maybe. No, he wasn't selling time where the lawyers would come and use the library. He was thinking that maybe someone would come to his toy store, and let's say a kid slipped and fell on a toy, and they sued for damages. Then when he got a lawyer, he could get a discount because he could provide the law library to the lawyer. He said, well, okay, we got a law library, you can come in and use the library for free, and in exchange you'll give me a discount for your services. That's what he said. Why did you say that?
Well, because I thought it would have some benefit to him in some way. By him having it gains him in that situation where it benefits him, so it could be considered.
Then you get a discount.
Yeah.
Okay. Anyone else? We're here two yeses. How many people think yes so far? I mean, just off your gut. It's early. Raise your hands up. Okay. That's probably more than half. Who is undecided? Undecided. And who's undecided? And I would take it you're a no. Amon? You're a yes. Okay. All right. So how the court goes through this, they just go through these three questions. So first, is the law library tangible in nature? Can they touch it? Yeah, that's an easy answer, right? Yeah. Second question, is it actively used in business? Operations. No.
Because it's only like when something happens and you need a lawyer.
Right, only used when a lawsuit happens. Now, here's the question, because there are other businesses that have assets, but they're not consistently used in the business. For example, let's take Caterpillar, right? Caterpillar builds these cranes and these large construction vehicles, right? Are those construction vehicles being used 24 hours a day, 7 days a week? No. Right? There's times that they're sitting in warehouse, and then there's times they're on a construction site being actively used. Now, just because it's sitting in a warehouse, does it mean that it's not actively used in operations? Not really. There's a plan to have it being used. That makes sense? Sometimes an asset will sit, but as long as there's a plan for it to be used, it will still qualify for actively used in operations. Everyone with me?
So then wouldn't that make the library qualify?
So that would make the library qualify. So now we're down to the third question. Expected benefit for future periods. Is there expected benefit?
Yes.
Is it? You say yes, why?
Well, because if he ever gets into any lawsuit issues, he's benefited. But that
If he gets into lawsuit issues, you say he'll get a benefit. By?
The lawyers
Is it
review
just-
it.
Is an expert.
What if the lawyer has a library? Then what happens?
There's too much.
Find a lawyer who doesn't.
That's it, right.
Or you don't end up using the library.
Well, this case happened pre-internet. So internet, back then, law libraries were very valuable and very expensive. So there were quite a few lawyers that might have some of the books, but not everything. So, no, that. Okay, so expected benefit is where this toy store owner got caught. Because the problem is that there is an assumed expected benefit. There is not a there's not a hard benefit. It's not like, okay, so think about insurance, right? For a second, in the companies, the judges use insurance, right? An insurance company, when you go to, let's say, have a, let's say you go and have a doctor's appointment, you know that you owe a $25 deductible. And then after that $25, everything else will be paid for, correct? So that is an expected benefit. In this case, does he know that he'll get a deduction or cost savings for his legal fees? No, he doesn't know. Also, does he know whether he'll be getting not just that he doesn't know how much it will be, but, I mean, that he'll get it, but he also doesn't know how much it will be. Everybody with me? With that being said, does not fit the expected benefits. Everybody with me? All right, so let's talk about another case. Now, this case is a little bit more adult, so a little forewarning to everybody. This is about the adult industry, adult entertainment industry. A lot of cases when you're talking about assets come out of adult entertainment, and the reason being is because there are a $1 billion industry, one, right? Maybe they're close to $1 trillion industry now. And secondly, they're mainly located in California. So California has a well-funded Department of Taxation that is consistently trying to to make sure that revenues are properly, maintained to the state of California. And you have an industry in adult entertainment that is also trying to make sure that they are not overly taxed by the state. So these two entities collide quite a bit, and you get some great cases out of it. So here's their landmark case. There was a young lady whom was in adult entertainment and had decided to have some plastic surgery done on her body, on her chest, and she also decided to write that off, put it on her books as an asset, and write it off, right, for tax purposes. Everybody with me? Good. I ask you, scholars, is that surgery and that augmentation an asset? No? Why you say no? Oh, well, I'll get back to you.
Definitely is actively used.
Okay,
I
here we
would
go.
say-
Is it actively used in operation?
It goes to the first, the last one is where it falls off.
Can I challenge on actively used for a second? What happens, because she's not always performing, what happens when she's at the grocery store? Or, at Chick-fil-A or something, right? What about that?
Same thing as the caterpillar machines.
Thank you.
Just ready to be used.
Right, right, that's good. For lack of word, right, that's exactly right, right? There is a plan for it to be used. Also, if you know anything about tax law, if you have a beach house or a house like an Airbnb and you don't rent it out 365 days, you can take a portion of it. Or let's say you have a vehicle that you use for business and personal use, you can take out the personal use and just have your mileage expense for business. So there's no problem with it not being actively used 24 hours a day, 7 days a week. Everyone with me? So yeah, so let's go to expected future benefit. Do we have expected future benefit?
I,
Yeah. No?
I think there's a case that could be made for yes.
What's that case?
I would say opportunity, future opportunity.
Future opportunity?
I mean, similarly, I feel like it's more attractive, I guess, I don't know, to like future jobs.
Mm-hmm. That's true. 3. Yeah, let's pick on some.
It's not the same, I guess, maybe like, more views or something.
Could have more views. Right. Yeah, that's true. I guess if it was these are old cases. I hate to say this. This is like I think this case happened in the 90s. This is like pre-internet. So there was no real like more views. I guess if it happened today, they would have more views, right? Yeah. What do you think?
I also think they would have more views.
You got another thought?
No.
No time.
No.
I concur with the great man in Sterling. The
No,
kind
but-
gentleman.
I do agree that, yeah, more views on that.
Cam? I told you it was a alright.
I mean, like, she obviously thought that it would benefit her to get the surgery, that's why she got it, so,
So how do we prove that it benefits you?
I mean,
Benefits food.
Huh?
Benefits food.
It benefits the business. How do we prove that?
Compare income or turnover.
Compare what? Not income. That's what, not compare income, compare
Profit of.
profits. happened in this case? The young lady had a write-up of the business prior to the enhancement and after the enhancement showed that she was more profitable afterwards, and therefore it counted as an asset.
So did the company pay for it?
Yes. Yeah, she's okay, so in business, we would classify her as a sole proprietor. Right, so it's not, don't think it's like GE, it's just, right?
So if it was paid for by somebody else, then why was she?
No, she's a sole proprietor, so
Okay.
remember, in the business entity assumption, the individual and the business are two different people, so the business would have paid. And then she would have put it on her balance sheet and wrote it and depreciated it. And that depreciation expense would lower her taxes. You're like shaking your head like, amazing. Amazing. Oh man, it's not, that is brilliant.
What?
Yes.
Did she come up with that?
Remember in the California, they're a union, like a lot of that is unionized, so I'm sure there was collaboration. I wouldn't say, I mean, I'm not gonna say, I'm gonna use a different C word, our president was always talking about collusion. I don't think it was collusion. I think it was more like collaboration. People got together and said, hey, I think we can do this. But it benefited quite a few people. I mean, since then. So, I mean, this lady should be applauded, in my opinion. I mean, they won, at least we should applaud that. Like, I'm a Colts fan, and I still applauded the Patriots for winning the championship, no matter how much I hate them. They were like, no. Respect. Yeah, there you go, respect. Maybe I'm just saying I respect. All right, so what are we talking about when we're talking about depreciation? What we're actually identifying is that we have something that's going to provide income for a company over a long period of time, more than a year, but that asset will have a decline in its usefulness, right, from when it starts, right? So when we first get it, let's say it was a piece of machinery that produces shoes. Initially, it might produce 10,000 shoes, but there'll be a time after 5 to 10 years, it might could only produce 8,000 shoes, 7,000 shoes, because of wear and tear and usage of the asset. Everyone with me? So when we're talking about depreciation, we're talking about usage of an asset over time, not some kind of mystery miracle thing that happens. You know, when you go to a car dealership, they're like, well, when you drive the car off the lot, it depreciates 40%. That's not exactly all the truth. That makes sense? Matter of fact, let's just call that a lie. Let's just throw that out. That makes sense? That's something they're telling you for sales. But the truth is, what we're actually calculating is usage of an asset. And there's no way we're calculating usage of an asset when the asset turns off a lot. Does that make sense?
Can you go back real quick?
Mhm.
Sorry, I should have the last part. Thank you.
Alright, so there are a couple of things I want you guys to remember when we're talking about depreciation. When we're doing a calculation, we do not depreciate land. Land is not a depreciable asset. Land holds its value. Land improvements do not. So when we are calculating what we depreciate and these things that go into an asset cost, it's not just the cost of purchase or construction of the asset. It's brokerage fees, taxes, attorney's fees, title fees, improvements, anything that goes into bringing that asset up, that it will bring in income, that needs to be calculated. Insurance, and all types When you're talking about machinery, right, installing, assembling the machine, price, taxes, transportation, as I said, insurance, right? Insurance while in transit, all those things need to be taken into account. Hey, Riley, can you shut the door, please? Alright, so what happens, if we buy Matrix Inc. purchased land and building for $200,000 cash, however, it appraised for $250,000. So let me give you guys some business advice here. I always take this thing. First of all, when you're buying a large asset like a house or a piece of building, you always want it to appraise for more than what you paid for. You always want it to appraise for more than what you paid for. Right? That's just a rule of thumb. Sometimes it might not happen that way. There's another thing of business, and I got this from Mark Cuban, and it goes like this. Let's say there are 4 people, including yourself, involved in a business transaction. Let's say you're buying a house, right? Go down the list and figure out what everyone is getting out of this transaction. So you may have the lawyer, they're getting their fees. You may have the realtor, and they're getting their commission. And then let's say you got the seller, and let's say you've identified that they're getting $200,000 appreciation in the value of the house. He says if everyone is getting something out of the deal, then you are the sucker. There has to be someone losing in a deal, especially the big ones. That makes sense? There has to be, there's no, this is his theory. There's no mutually exclusive deal, right? That someone is not, whether you're the sucker because you're taking more risk, additional risk, you might see this, you might say, this property is valued at $1 million now, but I can see it being valued as $2 million in 10 years, you're taking on the risk of holding it for 10 years, right? Or whether you see it as an opportunity, a piece of an opportunity. I get this building, I can refurbish it, and then I can maybe get it leased. That makes sense. So it's a piece of an opportunity. Either way, you're the one that's not coming out with something just tangible right off the bat. He says you're the sucker.
I thought you were talking about a house, but I guess you were talking about land.
You can be talking about anything, just a business opportunity
Alright.
in general. That makes sense? You're talking about large business. I always thought, wow, that's at least it should get you to thinking when you're in a business deal, what is everybody getting out of this? That makes sense? What is everybody getting out of this? And that should gauge on what you should be taking out of it. And the ugly truth is a lot of the business deals I've done, it kind of feels like I could say that person's but that person's not getting the full value. That makes sense? Here is all right. So the property appraised for $250,000. You're gonna pay. Matrix is paying $200,000. The building is $162,500. The land appraised for $87,500. How do we figure out? But we only pay $200,000. How do we allocate? How much of that $200,000 goes to land? How much goes to the building? You just don't say, oh, well, we paid $162,500 for the building, so that's what it gets. That's not how it works. What you do is take the total, 250,000, take the building divided by the total, and you get 65% for the building, and 35% of the appraised value was for the land. Multiply that by the 200,000 that you paid, and you'll see that 130,000 needs to be apportioned for the building, and 70,000 needs to be apportioned for the land. Questions on that part? Okay, good, moving on. Apportionment is very simple, so. All right, so now we'll talk about the depreciation. And we do this allocation because, remember, land is not depreciable. When you're doing your homework, make sure you do not depreciate that land. You only depreciate the building. So the allocation is important because it tells us what we're gonna depreciate. When we're doing depreciation, there's mainly three things we need to keep in mind. The cost of something. And we talked about that a couple of slides earlier, right? All the things that go into cost. Second is the salvage value. The salvage value is the value of an asset after its useful life. And since I have not defined useful life, I'll define it now. Useful life is the estimated time that a company or organization will use an asset. So we'll anticipate to use, let's say, these desks for 5 years. So that will be its useful life. Now, for you scholars, do not fret, because some of you might be like, well, where do we get useful life from? You'll get it from your local Internal Revenue Service. They print a book, and they basically tell you what the useful life is for everything. Now, I think you can even get it online, right? They'll tell you, desks are 5 years, and computers are 3 to 5 years, and buildings commercial buildings are like 30, I think 35, something like that, and residential like 25 to 30, so on and so forth. Everyone with me? So they'll tell you that number. So that's useful life. So let's go back to salvage value. So salvage value is the value of the desk after the useful life. So let's take these desks for example. Do you think that Nova's gonna get rid of these desks after 5 years of using them? No. Oh no. No, they ain't here for the long, right? Yeah, your grandkids might see these desks. Right? Papa, I saw your name on a desk. So yeah. So but after 5 years, let's say these desks were $100 a piece. After 5 years, I would not say that these desks are worth nothing. I mean, how much would you say they might be worth? $20. So $20 would be our salvage value. That's how much we would keep on the books for the desk for the rest of the time that we own it until we dispose of it. We meaning no. Everybody with me? So I'll show you straight line depreciation. We'll do, I'm going to show you 3 types of depreciation: straight line, units of production, and double declining. But for today, I'm just going to show you straight line, and we'll do double units of production and double declining in the next class. So straight line, the equation is cost minus salvage value divided by useful life. Cost minus salvage value divided by useful life. Cost minus salvage value. SD is shorthand for salvage value. Actually equals depreciable cost. Or depreciable value. Let's say depreciable value. So you might see in some books, you might see depreciable value, divided by useful life. Depreciable value is cost minus salvage value. So in our example, we have a $50,000 piece of machinery. We have a a salvage value of $5,000. 50,000 minus 5,000 is $45,000. We anticipate to have this asset for 5 years, so 45,000 divided by 5,000 is $9,000. This is a straight line, so every year out of those 5 years, you would depreciate $9,000. And what you would do on December 31st, the end of the year, you would debit depreciation expense, $9,000, and credit an account called accumulated depreciation, $9,000. Accumulated depreciation is a contra asset account. When we say contra asset, what do we mean? Come on, scholars.
What was it again?
Contra asset. What does that mean? Y'all remember? I know we had spring break, so. Oh, I don't have a slide. That this asset would go contra. This will be on the asset side of a financial statement, but it's contra to it. So what you'll see is equipment, $50,000. Then you'll see accumulated depreciation, $9,000.